Welcome, dear students, to the massive open online course on money and financial markets. In today's module, we are going to deal with a very interesting topic, the history of the Indian capital market. The main objective of this course are as follows. We are going to have an overview of the capital market from pre-independent times. We are also going to focus primarily on the 1960s and the 70s and try to figure out what really happened in the 1990s. We are also going to focus on an analytical sketch of the importance of capital market in economic development, the changes in the securities market that took place in the 1990s, the Government of India bond market in the 1990s, and also the lessons that we learnt from the 1992 crisis. The Indian stock markets are one of the oldest markets in Asia. Its history dates back to nearly 200 years ago. The earliest records of security dealings in India are meager and obscure. The East India Company was a dominant institution in those days, and business in its loan securities used to be transacted towards the close of the 18th century. The history of the Indian capital markets and the stock markets in particular can be traced back to 1861 when the American Civil War began. The opening of the Suez Canal during the 1860s led to a tremendous increase in exports to the United Kingdom and the United States. Several companies were formed during this period, and many banks came to the fore to handle the finances related to these trades. With many of these registered under the British Companies Act, the Stock Exchange Mumbai came into existence in 1875. It was an unincorporated body of stockbrokers who started doing business in the city under a banyan tree. Business was essentially confined to company owners and brokers with very little interest evinced by the general public. There had been much fluctuations in the stock market on account of the American War and the battles in Europe. So we can safely say that the orderly growth of the capital market began with the setting up of the Stock Exchange of Bombay in July 1875. Before we go or we proceed further, we need to understand what does the term capital market mean. This term basically refers to the institutional arrangements for facilitating the borrowing and lending of long-term funds. In the widest sense, it consists of a series of channels through which the savings of the community are made available for industrial and commercial enterprises and public authorities. Consequently, an ideal capital market is one where finance is used as a handmaid to serve the needs of the industry. Finance is accessible at a rational rate of return for any intention which offers a potential yield adequate to make borrowing valuable. The capital market must facilitate the movement of capital to the point of the highest return. If we try to categorize the type of capital markets that exist in India, we basically have two categories, the organized and the unorganized categories. In India, even the organized sector of the capital market was not fully developed. It was very ill developed till recently because of the following reasons. Point number one, since we know that agriculture is the main occupation of the people, this did not lend itself to basically any interest in the flotation of securities. Secondly, the foreign business houses hampered the growth of the securities market. Thirdly, managing agency system also accounted for ill development of the capital market, as managing agents performed both activities of promotion and marketing of the securities. The investment habits of individual is another very important concern. Restrictions imposed on the investment pattern of various financial institutions also played a major role. The unorganized sector of the capital market basically consisted of the indigenous bankers and the private money lenders. The main demand in the unorganized capital market basically comes from the agriculturalists, the private individuals for consumption rather than production, and even by the small traders. The supply of money that is the capital, comes usually from owned resources of money lenders and falls short of the requirements made on them. If we look at the Indian capital market just after independence, we find that after independence, and particularly basically after 1951, the Indian capital market has been broadening significantly, and the volume of savings and investment has really shown steady improvement over the years. A very important growth or indicator of the growth of the capital market is a growth of joint stock companies or the corporate enterprises. In 1951, there were around 28,500 companies, both public limited and private limited companies, with a paid up capital of around 775 crore of rupees. In the 1950s, Century Textiles, Tata Steel, Bombay Dyeing, National Rayon and Kohinoor Mills, these were the favorite scripts of the speculators. As speculation became rampant, the stock market came to be known as the Satta Bazaar. We know that in India, the planning process started from the 1950s onwards, and importance was given to the formation of institutions and markets. The Security Contract Regulation Act of 1956 became the parent regulation after the Indian Contract Act 1872, a basic law to be followed by the security markets in India. And to regulate the issue of share prices, the CCI or the Controller of Capital Issues Act was passed in 1947. So here we see that the regulatory framework was slowly steadied in the Indian economy. Now we come to what happens in the 1960s and 70s. The 1960s and 70s was characterized by war, the Indo-China War, the Indo-Pak War, and droughts in the country. And this led to bearish trends. Financial institutions really played a very crucial role here, like the LIC and the GIC. They helped to revive the sentiments by emerging as a most important group of investors. The markets also witnessed several golden times too during this period. Retail investors began to participate in the stock markets in a small way with the dilution of the FERA in 1978. Multinational companies which had operations in India were forced to reduce foreign shareholdings to below a certain percentage. And this led to a compulsory sale of shares, or basically issuance of fresh stocks. Indian investors who were applying for these shares encountered a real lottery, because those were the days when the CCI decided the price at which the share could be issued. And there was no free pricing, and their formula was very, very conservative. Now, if we look at the figure here I show basically two diagrams. Figure 1 shows capital raised in India's primary capital market in nominal terms between the years 1960-61 to 1990-93. And the second figure shows the share of equity in the total capital mobilized from 1960 to 1992. Now, both the sources for these two figures are the RBI report of currency and finance. So, in the first diagram or in the first figure, we find that after remaining dormant for nearly 2 decades since around 1960, resource mobilization in the primary capital market showed an upturn from the late 1970s. So, if you look at the figure, you will see that from the late 1970s onward, there has been a sudden upsurge in the capital raised in India's primary capital market, sudden upsurge. The growth also accelerated towards the end of the 1980s. The market capitalization ratio went up from about 5% of GDP in 1980-81 to around 63% in 1992-93. In 8 years, that is after 1986, the average daily turnover in the secondary market grew at around 35% per year. Between 1980-81 and 1992-93, the RBI index of the securities prices increased almost thrice, around 20.7% per year, as fast as the wholesale price index. This in principle reduces the cost of equity capital and increases prospects for capital gains. So, the takeaway from our details that I have said till now is this, that much of the growth has basically taken place in the debt securities. About a third is for convertible debentures. Proportion of equity or risk capital in market mobilization came down from about 90% in the early 70s to about 30% in around 1990s. This is shown in figure 2. However, in absolute terms, the nominal value of fresh equity capital raised grew at around 18% per year. And what is more interesting here is that the promoters' contribution in this more than doubled from 21% in 1970-71 to around 45% in 1990-91. This is a very favorable change, as the promoters now have a greater stake in the company's financial success. The proportion of equity underwritten also rose steadily. Again, this is a favorable change because it reflects the stock market's growing maturity. Moreover, as the market witnessed growth of new financial institutions offering a variety of services and tradable instruments with varying components of debt, equity, maturity and risk. So, the question that I put forth in front of you here is this. I have explained everything that had happened in India till the mid-90s. How do you think that the Indian capital market can compare with other emerging market economies during the early and the mid-90s? Now, basically, if I try to answer this question, reportedly, India is the biggest amongst all the emerging market economies with about 8,000 quoted companies in 1995, an increase over 70% over the 80s. And this was published in The Economist in July 6, 1996. The market in terms of market capitalization, India ranked 7th in 1995, in mid-90s. As the Indian firms were small, even though India ranked 7th in terms of market capitalization, the firms themselves were so very small that they do not figure in the list of top 30 firms in the emerging market economies. Another very important question that comes to our mind is, what basically explains this huge capital market growth in the Indian economy? There are certain reasons. One of the most important reason is the Indian government had taken a series of policy initiatives which was very important for this upsurge of the capital market growth. We know that around the late 70s, the stock markets really had only marginal role in financing the needs of the industry. Initially, dilution of equity holdings in foreign controlled rupee companies, popularly which were called the FERA companies because they attracted the 1973 FERA Act, was perhaps a conscious effort to stimulate the primary capital market. The FERA company's success was probably significant for further development of the capital market. This broadly coincided with a rise in the nominal interest rates and also the financial sector's growing resource constraint. Now, whenever there was this increasing reserve requirement and the priority sector lending, targets at concessional interest rates, commercial banks reputedly could not meet the credit needs of the industrial sector. So, in these circumstances, development financial institutions or the DFIs persuaded the firms to raise part of whatever funds they required from the capital market. And even in the 6th plan of the Indian government, that is from 1981 to 85, the government also anticipated, or the planning commission rather anticipated, the resource constraints faced by the corporate sector. So, the government also initiated many steps to encourage flow of household savings into the capital market. Like they hiked the interest rates on debt instruments, very easy convertibility into equity. They raised tax exemption limits on dividend income and easing the deduction at source on interest. Corporate tax rates were reduced. So, all these policies of the government helped in diverting funds of the household savings into the capital market during this period of time. So, the capital market reforms since 1991 perhaps reflect a continuation of a trend which was initiated around in the early 80s. Now, we would like to explore the role of capital markets and whether they have any impact on the economic or financial development of the economy. Some scholars like Mackinnon and Shaw, they have argued that state intervention in setting interest rates and quantitative measures of resource allocation, which is basically defined as financial repression, this basically affects adversely not only the allocative efficiency but also depresses the aggregate savings rate in less developed economies. And so, they feel that liberalization of financial markets are absolutely important. But their arguments are mostly related to interventions in bankings like the interest rate ceilings, the statutory reserve requirements and the directed lending programs at the concessional interest rates. Again, scholars like Cho argued that financial market liberalization may remain incomplete without an efficient market for equity capital as a means of spreading risk and reward. So, in principle, stock market as a part of a well-organized financial system has many advantages. It allows efficient risk sharing. Stock market basically induces gathering of information which gets reflected in stock prices, and these prices are then signals for resource allocation. In the secondary market, stock prices are powerful signals for managerial incentives and corporate governance. Attributing a part of the debt crisis of the 1980s in the LDCs to inadequate development of their financial markets, the World Development Report of 1989, published by the World Bank 1989, broadly reflects the preceding analytical position that I just placed in front of you. However, another very important point is there. We need to recognize information failure which can be acute in financial markets. The report argues for a sound supervisory mechanism and institutions to ensure their efficient functioning. Till some time ago, shortage of long-term capital was believed to be a major constraint on industrialization, since banks supply only short-term loans. As capital markets were practically non-existent or basically inefficient in most of the LDCs, state promoted the development financial institutions or the DFIs, and these were often supported by the advice of the World Bank and of course supported by their lines of credit, and they were expected to make up for the absence of an efficient capital market. So, we see two broadly competing perspectives here. Number one, the financial liberalization thesis, which states or which emphasizes the centrality of the stock market in resource allocation and the secondary market's disciplining role with independent supervision on managerial behavior. And the second very important one is the information economics theorists who on theory and history argue for the limited role. Now, we really observed huge changes in the securities market in 1990s in India. The equity market was prominent in the public imagination in the early 1990s because of famous stock market scam of 1992. Over the decade of the 1990s, a series of profound changes to market design took place. Number one, electronic trading started in 1994. All exchanges in India switched from floor trading to anonymous electronic trading. Risk containment at the clearing corporation. This was introduced in 1996. The largest exchange, National Stock Exchange, adopted risk management through novation at the clearing corporation. Other exchanges also substantially improved their risk containment mechanisms. In 1996, dematerialization was introduced. Almost all equity settlement today takes place at the depository. In 2000-2001, the derivatives trading was introduced. Equity derivatives trading commenced with index derivatives and derivatives on some individual stocks. And in 2001, we had the elimination of leveraged trading on the spot market. Future-style settlement and deferral mechanisms, which implied that the spot market featured leverage and futures market principles, were banned in favor of the rolling settlement. All these changes add up to a complete transformation of the market design of the capital market. However, a less noticed aspect of these changes is the remarkable extent of new human capital which was created to operate this new securities market infrastructure. A very, very striking point. Very few observers in 1991 could have predicted that traditional investors and stockbrokers would be trading on computers, giving instructions for transfer on the depository over the internet and trading in index futures and options. This transition from the physical share certificates to depository settlement involved a loss of thousands of jobs. That this process can take place without friction is a testimony to the labor market flexibility in the securities industry. Over the whole decade of the 1990s, at least 100 significant brokerage firms had gone bankrupt. That this exit had taken place without friction is again a very, very important and crucial testimony to the lack of rigidity in the securities industry. And next comes the Government of India bond market in the 1990s. In 1992, the Government of India bond market did not use trading on an exchange. It featured bilateral negotiation between dealers. A major consequence of bilateral negotiation is that the market lacks price, time, priority. Further, the lack of anonymity implies that a variety of malpractices can flourish, such as shading prices for favored counterparties, forming and enforcing cartels, etc. Bilateral transactions impose counterparty credit risk on the participants. This tends to narrow down the market into a club which has homogeneous credit risk and thus throws up entry barriers in the market. The negotiations between the dealers took place on telephone and were effectively restricted to individuals in 1 square kilometer of South Bombay. The rest of India could not participate in the market. This was similar to the BSE floor, which produced a South Bombay domination in the equity market. Bilateral transactions are extremely non-transparent in terms of both pre-trade and post-trade transparency. Before the trade takes place, trading intentions are not publicly visible. After the trade takes place, information about the trade is not made publicly available in real time. The settlement of the GOI, Government of India bond trades, is done through the database called SGL maintained by the RBI. SGL suffered from serious operational problems during the period of 1991. Partly as a response to these problems, participants took to trading in IOUs called the bankers' receipts or the BRs. The practice of bilateral netting flourished in a dangerous environment of a weak back office software and internal controls. These problems were present from the mid-1980s onwards. However, the increase in the transaction volume in the early 90s, and the euphoria on the stock market following the liberalization of the 1991 were the triggers which converted these systematic problems into a crisis. Most systematic crises in the financial sector are rooted in uncontrolled leverage. The scam of 1992 can be attributed to a two-stage leverage. One stage at the interbank Government of India bond market using the IOUs, and another on the stock market using the Badla. So if we look at the reforms in the 1990s, early 1990s, what do we see? Number one, improvement to SGL. So the RBI moved to computerize the SGL and implement a form of a delivery versus payment scheme. Second, enforcement of a trade for trade regime. The RBI set up a strong regulatory system which required that every trade must settle with funds and bonds. IOUs and all forms of netting were prohibited. Thirdly, trade reporting at NSE. Limited degree of transparency came about through the wholesale debt market, the WDM at NSE, where roughly half the trading volume of India's Government of India bond market is reported. The wholesale debt market, WDM, is not a market in the sense that it does not possess liquidity which can be used to match orders. Yet, it marks a step forward insofar as it reveals useful data about prices and traded quantities. These reforms, these 3 points that I just mentioned, served to close the windows through which the pervasive failures of clearing and settlement that generated the scam of 1992. So, what were the lessons that we learned from this 1992 crisis? Number one, the fixed income and stock market scandal of 1992 was rooted in market malpractice on the Government of India bond market. However, the stock market captured the public imagination, and for many citizens and policymakers, the state was evaluated in terms of its response to the 1992 crisis on the equity market and not on the bond market. So everybody felt that the crisis was that of the equity market, the stock market, but essentially it was a crisis of the bond market. To most citizens of the country, even today, the 1992 crisis is remembered only as the stock market crisis. The focus on the stock market crowded out attention of policymakers on the bond market and may have adversely impacted on the extent to which lessons were learned from the 1992 crisis. The failures of the bond market settlement were addressed by banning, netting and improving the SGL, but the vulnerability to malpractice that is innate in the OTC contracting was left intact. The equity and the bond markets in 1991 were both club markets in South Bombay. Today, the equity market is truly a national market, while bond market continues to be a type of club market still in South Bombay.